Let us begin with a statistic that should, by all rights, trigger an immediate internal audit of every investment portfolio in the West. $62 billion. That is not a gross trade figure, nor is it a projected budget deficit. It represents the net volume of liquid capital that physically exited the United States financial system to take up residence in Canada within a single, tumultuous calendar year. To understand the magnitude of this exodus, one must look at the inversion. Just 24 months prior, the economic gravity of North America functioned as expected. $50 billion was flowing north to south, as Canadian investors sought the perceived growth and indomitable security of the American engine. In the span of 1 year, we didn't just see a cooling of interest, we witnessed a $112 billion structural reversal. This is not market noise. This is not a standard correction or a seasonal hedge. This is what economists describe as capital voting with its feet. When wealth of this magnitude crosses a border in a singular direction, it signals that the tectonic plates of global trust have shifted. If your livelihood, your 401k, or your corporate strategy is anchored in the American market, you can no longer afford the luxury of indifference. Money does not flee the world's reserve currency without an existential provocation. The question we must dissect is, what made the Great White North suddenly appear to be a more fortified vault than the United States? The genesis of this fracture can be traced precisely to the first quarter of 2025. The U.S. administration, pivoting toward a radicalized version of economic patriotism, implemented a series of aggressive, non-negotiable tariffs. What was initially marketed as a surgical strike to protect domestic manufacturing quickly metastasized into a scorched earth trade conflict with Ottawa. Within 90 days, the most integrated bilateral trade relationship on the planet, a machine that moves nearly $2 billion in goods and services every single day, was thrown into a state of kinetic friction. But the true damage wasn't the 10% or 25% surcharge on aluminum or softwood lumber. The true killer was volatility. Markets are remarkably efficient at pricing in bad news. They can calculate the cost of a tax. They can adjust for the price of a gallon of milk or a ton of steel. What they are biologically incapable of processing is unpredictability. When the foundational rules of the Western liberal order, agreements like the USMCA, can be effectively neutralized by an overnight executive order, long-term planning becomes an oxymoron. Economist Paul Krugman identified this phenomenon as the uncertainty tax. It is a corrosive, invisible levy. It represents the premium a company must pay because it no longer knows if its supply chain will exist on Tuesday. It is the cost of a CEO refusing to sign a 10-year lease because they don't know if the border will be open in 6 months. This tax doesn't go to the Treasury. It simply evaporates value, leaving a vacuum where growth used to be. As the uncertainty tax began to compound, the psychology of the global investor underwent a fundamental mutation. For decades, the mantra was growth at any cost. In 2025, that mantra shifted to preservation at all costs. In this climate, Canada's traditional reputation, often criticized as being economically staid or excessively cautious, transformed into its greatest competitive asset. In a world of geopolitical pyrotechnics, being boring is a premium service. Capital stopped hunting for the highest alpha and started hunting for the most predictable harbor. This led to a historic anomaly in the currency markets. Historically, during times of North American strife, the greenback strengthens as a flight-to-quality asset. However, in the 2025 cycle, the U.S. dollar actually exhibited signs of structural fatigue, while gold, the ultimate barometer of systemic anxiety, surged to record highs. This reversal is a flashing red light. It suggests that for the first time in the modern era, the source of the risk was perceived to be the U.S. regulatory environment itself. Investors weren't just hedging against a bad quarter. They were hedging against a loss of institutional reliability. The most damning evidence of this shift is found in foreign direct investment, FDI. In the hierarchy of money, FDI is patient capital. This isn't the high-frequency trading of Wall Street bros or the speculative churning of crypto assets. This is the money used to pour concrete, install robotics, and hire thousands of workers for 20-year cycles. In 2025, Canadian FDI into the United States didn't just dip, it cratered. The figures plummeted from a robust $46 billion to a skeletal $14 billion. A 70% reduction in long-term commitment is not a pause, it is a divestment. Data from the latter half of the year suggests an even darker trend: active divestiture. Companies weren't just canceling new factories in Ohio or Texas, they were actively seeking buyers for their existing American infrastructure. This signals a permanent reassessment of the American risk profile. When patient capital loses its patience, it takes decades, not fiscal quarters, to earn that trust back. Once an assembly line is moved to a more stable jurisdiction, it doesn't move back just because a tariff is lowered. The trust deficit has a much longer half-life than a trade deficit. While the macroeconomists focused on FDY and currency swaps, the damage began to bleed into the fabric of everyday American life. The integrated economy is not just about car parts, it's about people. 1. The tourism vacuum. Canadian cross-border travel, a multi-billion-dollar lifeline for states like New York, Michigan, and Washington, evaporated. Small-town hospitality, retail hubs, and regional airlines faced an immediate liquidity crisis. When the world's longest undefended border becomes a psychological barrier, the economic friction is felt at every gas station and hotel along the 49th parallel. 2. The household levy. Despite political claims that foreigners pay the tariffs, the laws of mathematics remained undefeated. The 2025 conflict effectively functioned as a flat tax on the American middle class. By the end of the year, the average U.S. household was saddled with an estimated $1,000 in stealth costs. 3. The supply chain squeeze. From the lumber used to frame new homes to the specialized parts in medical devices, the cost of living spiked. This wasn't abstract policy. This was the reason a kitchen renovation cost 15% more, and why a new vehicle became an unattainable luxury for the working class. While Washington leaned into protectionist barriers, Ottawa executed a relatability offensive. Recognizing that the U.S. was abdicating its role as the predictable anchor of North American trade, Canada doubled down on institutional stability. The Canadian response included infrastructure accelerators, launching high-tech corridors and green energy initiatives to attract the R&D labs fleeing U.S. uncertainty, global diversification, rapidly expanding trade ties with the EU, CETA, and the Trans-Pacific Partnership, consciously reducing their single point of failure dependency on the American market, incentivizing the safe harbor, implementing tax structures designed specifically to capture the patient capital looking for a hedge against U.S. volatility. Whether or not these policies succeed in the long term is almost secondary to the perception shift. In the global theater of finance, if you are perceived to be the adult in the room, you get the keys to the vault. By 2026, the global consensus had shifted. Canada was no longer just a junior partner. It was a viable, more stable alternative for North American headquarters. We are now standing at a fork in the road of economic history. Trust, unlike a stock price, cannot be bought back during a dip. It is built in drops and lost in buckets. As we look at the remainder of the decade, 3 scenarios emerge. 1. The Great Reconciliation. Tensions subside, tariffs are repealed, and the $112 billion begins to trickle back. However, the risk premium on U.S. assets remains permanently higher. 2. The managed separation. The two nations continue to trade, but the deep integration of the last 30 years is dead. Supply chains become shorter, more expensive, and far more redundant. 3. The decoupling. Canada and the U.S. enter a period of prolonged economic divorce, where the North American trade bloc fragments, allowing Asian and European interests to fill the power vacuum. History teaches us that the decline of an economic superpower is rarely a cinematic explosion. It is a slow, quiet erosion. It is the sound of millions of rational investors making the quiet decision to move their money somewhere slightly safer, slightly more boring, and slightly more predictable. The $62 billion that left the U.S. in 2025 wasn't just money, it was a message. And the message is that the American century cannot be maintained through force of will alone. It requires the maintenance of the world's trust. Once that trust crosses the border, it doesn't always come back.